5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Tuesday. 90 more days. The U.S. and China trade truce has been extended, while Beijing's new guidance on Nvidia chips complicate the ties. Awaiting CPI, stock futures and treasuries rise as rate cut hopes hang in the balance. And the world's largest wealth fund notches its best quarter since 2023. Don't miss our interview with Norway Wealth Fund CEO Nicolai Tangen later this hour. Sure, okay, stocks, treasuries rising, but come on, barely. We are unchanged this morning. Let's call it what it is. S&P and NASDAQ unmoved. We fell yesterday, just missing out on all-time highs. We're less, though, than 1% away from that. CPI could make or break the trend. Small caps, those outperform. As I mentioned, bonds are little changed today. Why get out and take any risks ahead of CPI? 8:30 a.m. is when we expect that. If we take a look at the bond market, headline CPI, the expectation is for it to come in 0.3%. There's your bond market. As I said, little change, 427.91 on your 10-year yield. Let's look at some of the stocks, though, that are moving this morning. With the look at that is Valerie Teitel. Hey, Val.
Good morning, and Danny, let's start with Nvidia. After China has been urging local businesses not to use Nvidia's H20 chip, we are seeing Nvidia fall less than a half of 1%, though. But this comes as mostly what is seen as China trying to protect its domestic chip industry. We had some stocks in Asia, in China, trade limit up on the back of this. So this is a move broadly seen as China trying to protect its growing chip industry. Nvidia hurt off the back of that, down 0.4%. Let's stay in the tech space and move on to Intel. Bit of a different story here, rallying for a second day in a row, up another 3% in pre-market trade. This comes after the CEO met in the White House with President Donald Trump, and he had some more different rosy things to say about the CEO after calling for his resignation only a few days ago. So Intel stock rebounding for a second day in a row, up 3.5%. Lastly, I want to talk about Big Bear AI. This is a company that uses AI software, that sells AI software to analyze data to businesses. This stock is losing 28% in pre-market trade. Danny, they came in with a big miss in revenue, had guided, or the market had expected a loss of 6 cents per share. They came in with a 71-cent loss per share. This company does have some contracts with some big companies, one of them being the U.S. Army. Danny.
Valerie, thank you very much for those movers. We'll catch up with you later in the hour. Also this hour, a really fantastic lineup you don't want to miss. We're going to count down to the latest inflation print with Paul Donovan of UBS just around the corner, and Priya Misra of JPMorgan later this hour. Plus, we'll be speaking to Norway Wealth Fund CEO Nicolai Tangen on their best quarter in almost 2 years. But first, our top story this morning, truce extended. President Trump signing an executive order to continue deferring steep levies on Chinese goods for a further 90 days into early November. Joining us for the details is Bloomberg's Brendan Murray, who leads our global trade coverage. So, Brendan, another 90 days.
Yeah, exactly. So this takes a bit of uncertainty off the table that's been hovering over the U.S. economy for, the past several weeks. Would President Trump extend the truce, or would they re-escalate? No one really expected them to re-escalate in the aftermath of the global tariffs that President Trump announced last week. They tried the re-escalation in April, and it didn't go well. Financial markets reacted badly to the economic damage that was being done. So we get another 3 months to see if the two sides can work through some of their issues on the path to what President Trump wants, and that's a summit with President Xi Jinping. So we're a long way from that, and President Trump has asked China to purchase soybeans. We haven't heard anything from the Chinese on that front, but where we are now is the old trade war that President Trump started in his first term involved things like Chinese purchases of goods like soybeans, and now we've evolved into what is really a tech war more than a trade war.
Let's get into it, Brendan, because we learned that the U.S. would allow Nvidia and AMD to sell their most advanced chips to China, assuming the U.S. got 15% of that revenue. But it seems that China is pushing back. What do we understand?
Yeah, so China is sending a message to the U.S. and its tech companies, its chip producers, that we may not need these kinds of chips, and we're going to cast these as a security threat to our own domestic industries and the government in Beijing as well. So this is about trying to show the U.S. that China really has some leverage here with its rare earths versus what the U.S. has, and that are these high-tech chips. So this is about who's got the leverage over who, and China's trying to show that it has just as much leverage as Donald Trump says he has over China.
Brendan, today in America, it's also inflation data, CPI at 8:30 a.m. And there's some questions as to whether tariff inflation has started to seep in. You track global trade very closely. What have you seen in terms of whether companies are done stockpiling and finally importing some of the tariff affected goods?
Yeah, so it has been hard to see inflationary effects in U.S. economic data over the past couple of months. And as you mentioned, companies stockpiled, so they purchased and imported a lot of goods that didn't have those tariffs applied to them. But there's a real unevenness to this, and you hear big companies say we're adjusting, we'll absorb the costs, and we'll pass on a minimal amount to consumers. Those are the big companies. But what we've seen in our reporting over the past couple of days since the reciprocal tariffs took effect on Thursday is that these bills are coming due to small companies, and small companies are really what drive the U.S. economy. And so we are seeing those strains play out in the small business owners represented by the U.S. Chamber of Commerce and National Retail Federation. They're getting more vocal about how hard it is to withstand the hit of these tariffs. So the thinking is that it's still going to take a couple of months. We're seeing now, we're past the threats of tariffs, and now we're seeing the rubber meet the road on the real economy.
And for what it's worth, 6 a.m., we're going to get NFIB small business optimism figures. Brendan, thank you so much for joining us. Let's stay on the inflation print at 8:30 a.m. Paul Donovan of UBS writes, quote, hedging this inflation might become more difficult. The spending power of U.S. physical gold buyers was hit by 10% trade taxes. Inflation-protected government bonds offer protection not from inflation, but from what the BLS says inflation is. I'm pleased to say Paul joins us now. He's chief economist at UBS Global Wealth Management. Paul, it speaks to the complication of today's environment. So just how vulnerable are we as a market to stickier inflation?
Well, I think there are vulnerabilities, not so much from the direct effects of President Trump's trade taxes. Those will feed through. We would expect to see the April taxes sort of more or less fully represented in consumer prices by September. The August trade taxes will be hitting U.S. consumers early next year. But the question is the second round effects. Do U.S. manufacturers take advantage of this situation to raise their prices and expand margin? Do we see retailers engaging in profit-led inflation? And there's one or two warning signs that this may be happening. And the more that those second round effects come through, the stickier the inflation numbers are likely to be.
Do you expect that to happen to the degree it did during COVID, for example, Paul? Can we use that as a corollary of companies starting to rise prices, or is the consumer more resistant to it this time?
Well, I think there is more resistance on the part of consumers simply because consumers don't have the stockpiles of savings that they had 2-3 years ago. Now, that's not to say that consumers don't have any savings. They do, and they will use those to smooth out consumption as real wage growth turns negative early next year. But I don't think that they are going to be as willing to accept the profit-led inflation story. But we've already seen certain aspects of profit-led inflation come through. The economics profession has spent a lot of time looking at banana prices recently. Globally, banana prices are down. They're up in the States. That's not because of the tariff. Even with the trade tax, banana prices in the States should be down, but because there's a narrative around trade taxes. That's allowed consumer retailers to increase prices a bit more. So we are seeing some aspects of this come through already, and I think it will be a bit of a tussle over the next few months between retailers looking to raise prices and consumers less willing to spend.
Paul, it's one of my favorite parlor games. What measure do economists care about? Is it bananas? Is it shampoo? Is it something else? I'm glad you've added to that. Paul, you've also been really out front ahead with this idea that the data has become less reliable because of things like lower response rates. It's taken a new twist, as you know very well, with Trump not claiming that, but claiming politics is behind it. We have a new appointment to the BLS, who's previously the economist, the chief economist at the Heritage Foundation. Does it make the data even more concerning to you, or is it just the same old problems that we're going to continue to need to look through even in today's data of CPI?
Well, we have the same old problems. It's falling response rates. It's polarized politics, which means people give biased answers. We're just missing parts of the new economy. You know, where in the labor market data is TikTok content creator, for example? And it's the underfunding. The Bureau of Labor Statistics has cut back on the number of prices they measure because they don't have the money to do that. So one question is, will the new appointee, if confirmed, be able to do anything about the underfunding of the Bureau of Labor Statistics? I rather suspect not. But then there's a more serious question about, are they going to introduce a political bias to statistics? So we've got to remember there's 2,000 odd independent statisticians at the Bureau of Labor Statistics who one assumes will resist attempts to politicize them. But if we do end up with even a suspicion of politicized data, then that is going to do damage to the credibility of US statistics. People are going to say, yes, but you don't believe the official numbers. What's really going on is what I think with my gut instinct. And that way lies a very chaotic environment for financial markets.
Paul, have you already started to use a lot of alternative data sources? How are you assessing the current environment, and might you continue to going forward should what you describe happen?
So here's the problem with alternative data sources. We judge the reliability of alternative data sources by comparing them to the official data. And so if the official data is unreliable, what are you using to benchmark the alternative data sources with? So that is very problematic. With some alternative data sources, you're dealing with objective facts. Counting the number of ships outside the port of Los Angeles, that's an objective fact. The interpretation that is put on that, though, is subjective, and that's where the vulnerability comes through. I always suggest that when somebody comes to me and says, what are the three key indicators I should be looking at in economics? The answer is always the same. If you're only looking at three indicators, you're guaranteed to lose money, because you can't judge the world now through a very narrow lens. What we need to do is take a very broad sample of indicators to get a sense of the direction of the economy. Abandon this idea that economic data is precise. It's not. But we can get a sense of the broad direction using a wide number of indicators, and of course using a large number of economists to analyze those indicators.
Paul, I love it. We have just poured cold water all over today's CPI report, which, by the way, is at 8:30 a.m. And you should still tune into Bloomberg to see what those results are. Paul, thank you so much for joining us this morning. Paul Donovan of UBS. Let's get you some other top stories now that are trending on the terminal. President Trump downplayed expectations for Friday's meeting with Russia's Vladimir Putin after speculation that a deal favoring Moscow may get cut.
This is really a feel-out meeting, a little bit. And President Putin invited me to get involved. He wants to get involved. I believe he wants to get it over with. Now, I've said that a few times, and I've been disappointed.
Bloomberg learning that the search for the next Fed chair is expanding to include the committee's two current vice chairs, Michelle Bowman and Philip Jefferson. Two administration officials confirming that Kansas City Fed President Lori Logan is now also under consideration for the role when it's vacated next May. Elsewhere, Elon Musk is suing Apple. The billionaire founder of xAI Holdings is accusing Apple of making it impossible for anyone other than OpenAI to reach the top of the Apple Store charts. Coming up, Nicolai Tangen, the chief executive of Norges Investment Management. That conversation coming up next, one you don't want to miss. Stay with us. Welcome back to Bloomberg Brief. I'm Danny Berger in New York. Norway's sovereign wealth fund enjoyed its best quarter since 2023, returning 6.4% over the past 3 months, thanks to gains within the equity market. I'm pleased to say that joining us now is Norges Bank Investment Management CEO Nicolai Tangen. Nicolai, wonderful to see you this morning. And solid returns here, but the question needs to be asked. With stocks at an all-time high, concerns of sticky inflation and economic weakness, the impact of tariffs, take your pick. Just how sustainable are those levels of returns?
Well, I have to say this is a very strong quarter, and I'm personally quite surprised that markets have done so well. And in particular, the rebound we've had since April, I think it's very, very surprising given everything that's going on in the world.
It's surprising. And so, Nicolai, do you expect it to continue on? To your point, given everything that's going on in the world, just how resilient are we moving forward?
Well, we've been cautious for quite some time, and I think we really have to continue to be cautious. It's interesting because in Europe we have basically had no earnings growth in the first half, but we did have a lot of earnings growth coming out of the US, and in particular the US tech companies. So it's really the earnings growth is really driven from that part of the market. And then, of course, we've had very strong returns from the financial sector. And so it's been relatively broad within that area.
How does one even be and express that cautiousness in this environment, Nicolai? When bond volatility has continued to pick up, you see metals like gold subject to intraday fluctuations depending on what we hear from the White House regarding tariffs. How does one protect yourself in this more cautionary environment?
No, I think it's really an environment where you need to be very broadly diversified and very long-term in your investment horizon, because it's just like totally impossible to move around your portfolio, in particular when you are the size that we are, based on short-term movements. So the longer term you are and the more broadly diversified you are, I think the better you will cope with this situation.
Well, Nicolai, just given your passive exposure to U.S. stocks, I know this is no fault of your own, but one could definitely argue, maybe you're too exposed to tech. Nvidia is your largest holding. Does that concern you at all?
Well, the thing is that you could have started to be concerned about this many years ago, and wow, would you have lost out on some huge gains, right? So I think the way we talked about diversification of the portfolio some years ago, where we thought that 1% of the portfolio was a huge holding, I think it's very good that we didn't limit the position size at that stage. Now, when we see what AI is doing to our firm and the way we work, it's just like incredible. We think that last year we increased our productivity by 15%. This year, I think we can increase it even more. We are just using it everywhere now, and it's just fascinating how it improves and makes our work more efficient.
How much is it just increasing efficiency, Nicolai, and also maybe meaning you need less staff?
Well, so for the moment, what we're saying is that, hey, we are not going to cut staff. We are just going to do more. We're going to be just much better at what we're doing. And our goal was always to be the #1 player in using AI in our country and also within the financial sector. So we are not going to lay off any people. We are just going to do everything much better.
I'm sure everyone at Norges Bank is very happy to hear that, for those who are listening in, Nicolai. We're also at this moment, though, where these big tech and, yes, AI players are starting to be more subject to the politics. Nvidia, AMD having to pay 15% of their China revenue to the U.S., China pushing back, saying don't use H20 chips, the Intel CEO going over to the White House. Does that change at all how you view some of these U.S. companies? The fact that they're getting caught more in the political crosshairs, not just abroad, but where I am in America as well?
Well, the thing is that it's like super interesting because the very close ties between technology and geopolitics. This is something that really exploded like 3 years ago with the advent of ChatGPT. Now, of course, you have AI being built into everything from self-driving cars, medical research, weapons, all these kind of things, right? So the link here between geopolitics and technology is just so strong and so important. So you need to just have a different lens when you analyze markets these days.
Have you hired more geopolitical analysts, Nicolai? How are you handling that?
Well, we try to do even more deep thinking than we did in the past. I think to really have a credible kind of resource center inside, you would need to hire at least 50 people. Well, we try to listen to the best experts worldwide. And then, of course, as I said at the beginning, to be widely diversified and have a very long-term view so that we really participate in this value creation.
How much of the diversification, Nicolai, is also looking away from the U.S.? Europe stocks gained the most in your portfolio, 17.8% versus just 1.4% for North American stocks. At this point, would you consider an even greater tilt towards Europe?
Well, there is a big currency effect in the results here. And because of the movements in the Norwegian kroner. We have more than half the portfolio in the US and then just under a third in Europe. And so we are really happy with the geographical diversification we have for the moment.
Well, it goes back to this question, Nicolai, and I know you've been asked it before to start the year, but it's not gone away. This idea that perhaps brand America has been hurt with the political volatility happening in the U.S. Do you think that that's a narrative that could get more legs, that at some point you might need to re-examine just how much of the U.S. you hold?
Well, it's a very interesting question. Of course, you're posing here. Uncertainty is generally not very good for stock markets, and it's not very good for companies. And so when we have uncertainty about tariffs and so on, that's not a positive. At the same time, we are seeing very, very strong developments, strong R&D, strong innovations, and so on coming out of the large US companies. So I would say we are really, really pleased with our holdings, and I feel we are in the right place.
When it comes to your holdings, Nicolai, you also recently divested from 11 Israeli companies. You cut ties with external managers from Israel, too. All of that amid pressure before an election happening there. Is there a real risk, though? And critics might look at this and say it opens the door to being used as the fund being used as a political tool. Is that a real risk?
Well, it's a very, very important question because it's important for us not to be political. We are an investment fund. We have one overriding goal, and it is to make money, of course, within the mandate we have from the ministry. Now, we divested from these Israeli companies, not because they were Israeli, but in this case, because we wanted to simplify the portfolio management we did in Israel. So these were companies which were not in the index, and we decided to take home the asset management. We discontinued 3 external relationships with external managers, and then we decided to do it ourselves, just to kind of simplify what we are doing and how we deal with this.
Are you evaluating at all changes to some of your responsible investment strategy as part of this, Nicolai?
Well, we are continuously evaluating this. We also have a separate entity called the Council of Ethics, which is looking into more ethical aspects of our investments. And then in terms of being invested in Israel, that's a political question. It's not a decision that we do. So what we do is to make sure that we invest in Israel in a responsible way.
Hey, Nicolai, we literally only have 1 minute left here, but it's going to be CPI reports in America. Are you gearing up for maybe a more stagflationary environment in what is your largest holding?
Well, we do see that there are some real inflationary pressures. I mean, one thing, it's of course coming from the tariffs. We are seeing some push from various kind of climate situations too, through worse harvests and raw material prices, which are moving up. And so that is why we also think that there is a link between climate risk and financial risk. I do think there is for sure a danger that inflation could be quite persistent here.
Nicolai, wonderful to speak with you this morning. Thank you so much for joining us. That is Nicolai Tangen, CEO of Norges Bank Investment Management. Coming up on the show, JPMorgan's Priya Misra sets the stage ahead of today's big U.S. inflation print. That conversation is coming up next on Bloomberg. It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Tuesday. 90 more days. China and the U.S. extend their trade truce, averting higher tariffs for now. New guidance on chips. Beijing urges local companies not to use Nvidia's H20 processors. And awaiting CPI, stock futures and treasuries little changed as rate cut hopes hang in the balance. So we closed about 0.25% lower yesterday, missing out on an all-time high, basically unchanged for both the S&P and NASDAQ. But why would you want to put any risk on, perhaps ahead of today's CPI report, 8:30 a.m.? Russell 2000 does outperform for this bond market. Also little change this morning, the expectation for inflation, 0.3% for core. We'll get into that with Michael McKee in just a moment for 27.52 on your 10-year yield. Let's first, though, look at some of the stocks moving pre-market. With that is Valerie Teitel. Hey, Val.
Good morning, Danny. Let's start with the check on Nvidia. After China has been urging companies not to use its H20 chip, we're seeing Nvidia trade just slightly lower in the pre-market, down 0.3%. But this comes days after, Danny, that Nvidia got those export licenses to begin exporting those chips into China after the Trump administration put a pause back in April. Let's stay in the tech space and move on to Intel. Bit of a different picture here. It sounds like the U.S. president has changed his mind about the CEO after meeting with him in the Oval Office yesterday. Says that the CEO has an amazing story, and this is helping that stock turn around, up 3.3% in pre-market, coming after gains yesterday in the session of around 3% as well. A big departure from Trump's language only a few days ago, calling for the Intel CEO's resignation. Let's move on to earnings. Big Bear AI, this is a enterprise AI software company that helps companies analyze data, came out with some very depressing numbers when it came to revenue, with a 71-cent loss per share, with the estimate was around 6 cents. We're seeing Big Bear AI stock down some 28% in pre-market trade. They have some big contracts, especially when it comes to government contracts with the U.S. Army. Danny.
Valerie, thank you very much for that roundup. Now, we are 3 hours away from the latest inflation print. Let's bring in Bloomberg economics editor Michael McKee, who is awaiting that data. Mike, what you looking out for?
Well, you said just a minute ago that the rate cut hopes ride on this, and ordinarily I'd say that might be a little hyperbole, but in this case it's actually true, because if we get a reasonably decent number, it would enable the Fed to cut rates without worrying about inflation rising. The question is, do we get that number? Let's look at what the forecast is. For headline, we're looking for a 0.2% gain, and for the core, 0.3% gain, which would push up inflation, but only by a tick in each category. The question is, and a lot of economists have put this out overnight, they're thinking that maybe we might see that core rate tick up to 0.4. And if that's the case, we go over 3% of the core, and then you've got a problem for the Fed, because inflation looks like it's breaking out. Everybody's going to be looking at the breakdown of what comes from CPI and looking at categories that could be influenced by tariffs. And of course, they've just started to go on, so there is more to come in the months ahead. But this will be very important for the Fed's September meeting.
It'll be important for the Fed September meeting and from whatever truth socials we might get from President Trump. Now, on that, Bloomberg reporting that there's an expanded search now for the Fed chair. Mike, what's our understanding on who is in the candidate list now?
Well, they keep adding people at the Fed. Mickey Bowman and Philip Jefferson, the two vice chairs, getting recognized now, along with Lori Logan, who's the Dallas Fed president and was head of the markets desk at the New York Fed. How serious those are, we don't know. Bloomberg reported last week, of course, that Chris Waller might be the favorite for the job, but apparently Scott Bessent wants to interview a lot of people before he gets there.
Well, one job has been secured, and that's the new head of the BLS. So this CPI report will be the first with E.J. Antoni to be leading the Bureau of Labor Statistics. What do we know about him? What difference could this make, if at all?
Well, I have to mention he won't be in charge for this CPI because he's got to be confirmed by the Senate, and it could be a bit controversial when he gets to his hearings, because this is a clearly political choice by the president. He's said a lot of things about the BLS in the past, much of them on X. The BLS data is just a random number generator from the magical world of make-believe. He says the revisions that we saw in the jobs report show a negative bias, and he's questioned the BLS's methodology. He says they need a top-to-bottom BLS review of how they do things. Now, the BLS commissioner doesn't have a lot of influence on a day-to-day collection of statistics, but overall, he could raise questions as we go forward about the BLS's methodology. He and the president saying they want to bring back trust to the numbers, but Wall Street really hasn't lost trust in the numbers. Everybody knows that there are some statistical problems, but it's still seen as the gold standard. The president might be wanting to confuse people so that if we get more bad jobs reports, people will worry about the numbers instead of the bad jobs report.
I was going to say, there's no way that Wall Street is not going to be trading off of today's 8:30 a.m. CPI numbers.
Indeed.
Mike, thank you so much. We look forward to you breaking down the data when it comes out. That is Bloomberg's Michael McKee. Let's continue the conversation now with Priya Misra, portfolio manager at JPMorgan Asset Management. Priya, we'll leave the politics aside for now, as much as we possibly can. But you've been writing about this idea that shades of stagflation are starting to show up in the data. Do you expect today to confirm that?
I do. And I think you're going to see it in goods inflation. We started to see it last month. Goods inflation started to pick up. I think you'll see some more of that. And more tariffs have gone into effect. So I don't think this is like the peak of inflation. I think it's going to happen all through the third quarter, fourth quarter. I think you're going to see goods inflation. So beyond that headline number, which we'll be looking at that second place of decimal rather than just 0.3 or 0.4, we'll be looking at services. And I think that's the interesting part. You're seeing the stagflation side on goods. What are we seeing on services? We're seeing service inflation actually largely offset goods inflation. May not offset today because that goods inflation has that tariff impact. But if service inflation continues to decelerate, I think it does a couple of things. It tells us that that stag part of stagflation is still alive, because why is service inflation declining? That a lot of that is discretionary spending. If consumers have to pay more for goods, they're going to cut back on services. We're also seeing it in other data. So as we talk about data quality, let's look at a broad swath of data. We're seeing real personal consumption expenditures for the US first 6 months of this year, 1%. That was running at 3% last year. So there is a slowing in spending. If you see it in service inflation declining, it tells you that demand side is slowing. Also allows the Fed to look through that tariff inflation. I think that's what every market's looking for, that can the Fed cut rates? And maybe you get a knee-jerk reaction that this number is hot, maybe the Fed doesn't cut. But Chair Powell told us that they might look through tariff-related inflation. I think that's what they'll be looking for. My concern is if service inflation actually doesn't decelerate as much, does the Fed then get a little nervous that what if this inflation is like the 21 inflation? I don't think it is. I do think it's very different today, and inflation is likely to be one-off, this tariff-related inflation. But I think we'll be watching that service side importantly to see that, whether the Fed can look through it or not.
Right. Well, it sounds like a Fed mandate that's already in conflict at this very point, Priya. So was it already premature for this market to run up and price something close to 90% odd that we'd get a cut next month?
So we are in the nightmare scenario for any central bank where that dual mandate, particularly for the Fed, is in tension. But here's the thing. I think the starting point was that the Fed was in restrictive territory in terms of monetary policy. So for the market to price in rate, beyond the politics of this, I think you listen to Governor Waller, Governor Bowman, they're talking about let's reduce the level of restriction, which is 100, 150 basis points of cuts. I think those cuts are actually fair. Whether it happens in September, October, or December, I think depends crucially on today's CPI, on the next payroll report. But the Fed is in an easing bias. I think the market's pricing that easing bias. What the market's not yet pricing in is move into accommodation. I think if you see growth continue to slow down, if you see that labor data, we go from the low fire, low hire to actually higher fire. I mean, if the firing starts to pick up, if you see claims pick up, I think then the market prices in a lot more cuts. What we're pricing in right now is this idea that it's a tariff-related rise in inflation, soft landing, growth is slowing, but not into recession. So the Fed can just remove that restriction. Chair Powell seemed open to it. He wasn't suggesting September rate cut, but he was open to cutting later this year. The dot plot suggests that as well. I think the market's fair in pricing those cuts in. And that's why they might look through today's any high number, as long as it keeps the narrative alive that this is goods inflation, services is still sort of decelerating.
Well, the argument that Bowman and Waller have been making is surrounding the labor market. But Priya, is there a risk of, some have said the idea that we have less job openings is just because there's less supply, and that's driving it. And a cut isn't going to bring more labor supply into the market. And if anything, it might fuel inflation. Is that a real risk, just given the balance of where we stand in the labor market?
So the labor market's really tricky because, I was talking about the decline in demand. Companies are hiring less, but the supply side is also slowing. And that's why Chair Powell actually said, the labor numbers are slowing, but so is the supply remains in balance. And that's why the unemployment rate is not moving up. And so I guess you were asking two questions. Is the labor market weak? I do think it's on edge. I mean, you look at the breadth of hiring, it's slowing. you know, you look at overall demand side is slowing. And so I think the Fed should reduce the level of restriction. Your second question, does it help? Monetary policy works with lags. So it's going to take a while. And if you really need growth to pick up, I think we need to move into accommodative territory. So I'm not very confident that even if the Fed cuts rates, that demand just picks up. Now, we do have some positives out there. If some uncertainty goes away, you do have the one big beautiful bill as some of those policies get into effect for businesses. Is that a positive? Businesses came into this shock with very solid balance sheets. So maybe we can stay in the soft landing. That's our base case scenario. And that's why we're leaning into credit. We're leaning into some high quality spread product. But I think you have to worry about if things are slowing down, these rate cuts will not be enough to get us out of it. And that's why I think owning duration makes sense.
I was going to say, Priya, it feels a little bit crazy to be having this conversation about the labor market weakening, maybe some stagflationary concerns, yet spreads are incredibly tight and stocks are just below all-time highs. Is it a whistling past the graveyard kind of situation that we're in right now? Are we complacent?
I think there's some element of that, but the market's looking at top-down data that's actually, okay, it's showing slowing, but not recession. Bottom-up data, look at company earnings, look at balance sheets. Companies are solid. They're not suggesting that they need to lay off or they need to cut costs. The market's pricing that scenario in. And the hope that there is a Trump put and there is a Fed put. And the Fed is telling you, and I think both sides, if you look at policy actions over the last few months, that put is in the market's mind. I do worry if, you know, there's a non-linearity typically. If things slow down, does it slow down enough where things actually get a lot worse and then those puts come into effect, but it takes a while to play out? And that's why I think you should think about portfolio construction, owning fixed income. This is why we're getting inflows into fixed income. Equities are doing so well, but why are people buying, you know, 5.5%, 6% investment grade corporate debt? Is it's giving you that cushion where if things slow down, risk premiums rise, those rates can fall a lot more. I think interest rates in a slowdown scenario have a lot of room to fall. I think that's why people are piling into fixed income along with their equities as a hedge. I think that hedging property is very much alive and well.
Priya, we're going to have to leave it there. Thank you so much for getting in early for us ahead of that data. Priya Misra of JPMorgan, thank you so much. Now, coming up, Truce extended the U.S. pausing higher tariffs on Chinese goods for another 90 days. At least that is one hurdle crossed for this market. We're going to have that conversation coming up next on your Bloomberg Brief.
We've been dealing very nicely with China, as you probably have heard. They have tremendous tariffs that they're paying to the United States of America. The relationship is very good with President Xi and myself.
President Trump touting his relationship with Chinese counterpart Xi Jinping. The U.S. extending a pause of higher tariffs on Chinese goods for another 90 days, stabilizing or at least attempting to stabilize ties between the world's two largest economies. Joining us for more is Bloomberg's Brendan Murray. So, Brendan, another 90 days.
Yeah, exactly. So this gives market participants, the American importers and others a bit of a relief. This was pretty widely expected that they would extend this truce, and this seems to be the new normal. These 3-month increments where Beijing and Washington will get together and have these talks. Secretary Bessent has led them, and they'll try to maintain this going forward on the road to some sort of deal that President Trump wants to strike with President Xi Jinping, and something similar to the Phase 1 deal that Trump signed with Xi in the first term of Trump's first administration. So we're a long way from that. It took 3 months to kind of get to just an agreement to extend the truce. So it's not like they're making big progress in any heated or negotiations. President Trump wants China to buy more soybeans. We've heard nothing from China on that over the past 36 hours. But the bottom line here is that there is no re-escalation, and the two sides will continue to talk. And as long as they're talking, they're not raising tariffs on each other.
And that, to many, will be a relief. But Brendan, is it enough of a relief for companies in America that bring in goods from China? Is another 90 days enough to give them the certainty to begin that process? Or does can kicking continue to hurt some of corporate America's purchasing plans?
Yeah, I mean, the only thing that's certain in these negotiations and this next 90 days is that tariffs are now a reality rather than a threat. And they're not just on China and on goods from China. They're on, they're on 50% on goods from India, 15% from the European Union. So what we're seeing now is the end of the threats and the impact on the real economy, and whether that leads to inflation or stalling out of investment, we just don't know yet. Commerce Secretary Howard Lutnick has said by the third or fourth quarter of this year, we'll see this roaring Trump economy. Well, we're not too far from that prediction, and nothing about the U.S. economy looks roaring at the moment. In fact, things seem to be slowing.
Brendan, thank you very much for your coverage this morning. That is Bloomberg's Brendan Murray. But let's stay with China and trade. Bloomberg learning that Beijing is urging local companies to avoid using Nvidia's H20 processors. It comes after the U.S. government cleared Nvidia to sell advanced semis to China, provided it and AMD shared 15% of those sales with Washington. I'm pleased to say we are joined by Bloomberg tech host Ed Ludlow, who is in London. So it's up for us. Ed, it is so great to see you this morning. And the rock in a hard place that Nvidia finds itself in is just increasing with the latest coming out of China. Just how big of a setback might this be for Nvidia?
Well, there's probably some recalculation of how immediate term Nvidia's ability to draw revenues from China will be, in part because, Nvidia was really clear when the president was speaking at the White House in response to him confirming the 15% revenue share deal. They haven't shipped any H20s to China so far, essentially, in 2025. The analyst community interprets this as being a tactic from China in the context of the broader negotiations between the two countries, either because they want to push President Trump to open up access further to more performant accelerators that go beyond what H20 is capable of, or they want the opposite. They want to safeguard their own domestic champions, being Huawei. But at the end of the day, Nvidia has not had access to the China market for some time. The reporting we did overnight predates yesterday's event at the White House and press conference at the White House. And it's something that's very normal, particularly for China's internet watchdog to do, caution government and state-backed enterprise entities from using foreign technology if there's a security concern. We just continue to see more involvement from both governments in tech companies. Intel, the latest. We know what Trump said last weekend about calling for the CEO to step down. He put this on Truth Social after meeting with the Intel CEO, Lip-Bu Tan. The meeting was a very interesting one. His success and rise is an amazing story. And how is this relationship evolving, and what does it mean for Intel? It's evolving quickly. Things have turned around very quickly for Lip-Bu Tan in terms of the president's public commentary about him. On paper, Intel is everything that this administration is pushing for. It is a U.S. company that has been trying, in advance of Trump taking office, they were a great beneficiary of the CHIPS Act under the Biden administration, to bring a larger manufacturing of semiconductor footprint to the country. They have poorly executed on it. That's probably an understatement. And a part of what Lip-Bu Tan has had to do, away from the politics of his background and relationship with China, which was known by the board of directors when they appointed him. It's been known by the semiconductor industry for about 40 years, even if it was a surprise to the president, is to get Intel operationally firing. And, it seems, based on the president's statement on Truth Social, that they will continue talking at cabinet level, and maybe Intel can move as quickly as Nvidia and AMD have been able to move, and foreign entities like TSMC and Samsung to onshore what is already quite big capacity for them. But having the president in your corner, we know, has been helpful to the tech industry. Hey, Ed, finally, away from politics, but maybe not that far away from politics, we have this accusation from Elon Musk that Apple was unfairly favoring OpenAI in its App Store over xAI. What is his charge? Is there any validity to it? Okay, there are several posts on X overnight from Elon Musk. This is a very common occurrence to wake up to. The core of the accusation is that Apple positively or in an affirmative way alters or influences the rankings on top in the App Store. Musk's accusation across several posts is that because Apple has an underlying technology relationship with OpenAI, they use OpenAI's models and also have a distribution agreement, that somehow ChatGPT is getting more favorable treatment than XAI and Grok is getting, as well as the X social media platform. All I can tell you, because Apple's not commenting on the story, is that Apple's top rankings, top free, top paid for apps on the App Store are dictated by an algorithm that takes into account downloads over time, download volume, and also metadata that the developers put into the app's underlying code, making it relevant for search on the App Store. That's as far as we've got, but it's not uncommon for Musk to be litigious in pursuit of either defending or going on the offense for his broad portfolio of companies.
And Ed, aren't you lucky that you're in London, so you get to be awake during Elon Musk's midnight tweets? Ed, thank you so much for joining us. That's Ed Ludlow, and you're watching Bloomberg. You're watching Bloomberg Brief with Danny Berger in New York. Let's get you set up for your trading day today. OPEC, they are set to release their monthly oil market report this morning. Then it's the big one, US CPI. That comes in at 8:30 a.m. Eastern time. We'll also get some Fed speak from Barkin and Schmid. That comes in at 10 and 10:30 a.m. respectively. Two companies to flag in the pre-market, one being Nvidia. Little change despite the fact that China reportedly, according to our reporting, is telling companies to pull back on their purchasing of H20 processors, despite the fact they reached an agreement with the U.S. government. Meanwhile, Intel, another politics-related story, up 3% after the CEO met with Trump, and the Trump had positive posts about that. All right, that's it for Bloomberg Brief. Surveillance takes things from here.